Think back to 2020, right? Central banks all around the world pumped just trillions of dollars into the global economy to try and save it from the pandemic shutdown.
Yeah, I mean, it was literally the largest rescue operation in the history of finance.
Right. But the irony of that whole rescue, it's just staggering when you really look at it. Because the very consumers that those central banks were trying to protect, they ended up basically weaponizing that money.
They absolutely did. They rotated all that spending so aggressively into physical goods.
Yeah, buying mountains of laptops and like patio furniture and
Exercise bikes.
exactly, exercise bikes. And they literally broke the global supply chain, which ignited, the worst inflation we've seen in 40 years. So the rescue mechanism itself is what caused the next crisis.
Well, we always tend to assume that the global economy just operates like this pristine, predictable machine, right? Like if a central bank pushes a button, a very specific calculated outcome is just going to happen.
Like a vending machine.
Yeah, like a vending machine. But the reality is that the transmission mechanism, that link between the policymakers and the actual real-world economy, is incredibly fragile. It's deeply psychological. And honestly, it frequently just malfunctions in ways that all those traditional models completely fail to predict.
Which is why today we are officially putting on our investigative financial journalist hats. We are going to rip up the floorboards of that transmission mechanism.
Yes, we have a massive stack of sources for this deep dive today.
We really do. We've got this cross-country primer on global macro systems. We have some really dense analyses of central bank structures, a breakdown of the modern credit cycle, and this incredibly granular consumer macroeconomic playbook.
It's a lot of material.
It is, but our mission here is to demystify this stuff for you. We want to shine a really bright light onto the actual plumbing of the financial system. We're bypassing all those neat little graphs you see on the evening news to examine where the money actually flows, how the pressure builds up, and why the pipes inevitably burst.
And the timing for this specific investigation is just critical right now because those traditional economic models, the ones you learn in literally every macroeconomics 101 class, they are fundamentally obsolete.
They're broken.
They are completely inadequate for diagnosing the true health of the system today. I mean, we really have to discard this outdated textbook theory that markets crash simply because debt levels get, quote unquote, too high.
Right. The danger isn't actually in that big, scary aggregate headline number. The real culprits, according to the sources, are path dependency and structural mismatches on balance sheets.
Okay, let's unpack this. To really understand how those mismatches cause the plumbing to rupture, I think we have to start right at the water source. We need to evaluate the master plumbers, which are the central banks.
Exactly. They're the ones controlling the baseline cost of capital and the overall flow of liquidity. Right, but the structural mandates of these different institutions vary wildly. Like, if we evaluate the U.S. Federal Reserve, obviously the undisputed heavyweight of the system, we find this unique internal conflict that just doesn't exist in most other countries.
Yeah, the Federal Reserve operates under what we call a dual mandate. So Congress legally requires the Fed to pursue both maximum employment and stable prices.
Which is huge. That's a massive structural distinction from the rest of the world.
It really is. Most central banks out there have a single mandate, which is essentially just kill inflation. But the Fed is forced into this constant, really difficult balancing act.
Right. So they might tolerate a slightly hotter inflation rate if it keeps the domestic job market from totally collapsing.
Or they might have to induce a domestic recession just to bring those prices back under control.
But here's the thing. That domestic balancing act by the Fed, it creates these violent shockwaves internationally. Because, well, they control the world's primary reserve currency. So explain the mechanics of that.
Yeah.
How does a purely domestic policy decision made by the Fed in Washington end up exporting financial instability to a country on the complete other side of the planet?
Okay, so it all comes down to the interest rate differential and global capital flows. When the Fed decides that U.S. inflation is running too hot, they raise the federal funds rate.
Okay.
This mechanically makes U.S. Treasury bonds offer higher yields. Now, I want you to imagine you are a global asset manager, right? You're sitting in London or Tokyo.
Okay, I'm in Tokyo.
And you see that you can get a guaranteed 5% return on a very safe U.S. government bond, whereas your local domestic bonds might only be paying like 2%.
Well, obviously, I want the 5%. I want to move my capital into the United States to capture that higher yield.
Naturally. But to buy a U.S. bond, you have to use U.S. dollars. You mathematically cannot buy it with euros or yen.
Ah, okay. So I have to sell my local currency and buy dollars.
Precisely. And that massive global demand for dollars causes the value of the US dollar to just surge relative to all those other currencies. And this right here is where the wrecking ball really swings into emerging
Not
markets.
so.
Because over the past decade or so, when US interest rates were sitting near zero, corporations and governments in emerging markets borrowed really heavily in US dollars because the interest rates on those dollar loans were way cheaper than borrowing in their own local currencies.
Oh, wow. Okay, I'm seeing the trap here. So an emerging market corporation issues these dollar-denominated bonds, but they're selling their actual products domestically. So their revenue is generated in, I don't know, Brazilian reals or Indonesian rupiah or South African rand.
Exactly. And suddenly, the Fed hikes rates to fight inflation in the US. The dollar skyrockets in value. Now that emerging market corporation has to take their local currency revenue, convert it into a much stronger, vastly more expensive US dollar just to make their standard monthly debt payment.
That's brutal. So the cost to service their debt just mathematically exploded, even if their underlying business hasn't changed a single bit.
Right. So by attempting to just cool down inflation in, Texas or Ohio, the Federal Reserve effectively exports violently tight financial conditions to the entire developing world.
Wow. Okay, so how does Europe defend against that kind of external pressure? I mean, if we move the tour over to the European Central Bank, the ECB, their architecture is entirely different, right? They don't have that dual mandate.
No, the ECB is this wild supranational experiment. Their primary overriding obsession is just maintaining a target inflation rate. But their architecture creates arguably the most complex monetary nightmare in the entire world.
Because they manage one currency, the euro, but they have to set one single interest rate for 20 entirely different sovereign countries.
Right. Which introduces what the sources call fragmentation risk.
Okay, fragmentation risk, meaning you have to set monetary policy for Germany, which is this industrial export powerhouse, with incredibly strict fiscal discipline, while simultaneously setting policy for Italy, which is a country carrying just a massive, structurally ingrained load of sovereign debt.
Exactly.
Are these central banks just playing whack-a-mole with different sized hammers? Like it feels like the Fed has this giant sledgehammer, but the ECB is trying to hit 20 moles at once with the exact same hammer.
That's a great analogy. It's like trying to drive a massive semi-truck where half the wheels are on smooth asphalt in Germany and the other half are deep in the mud in Italy, but you only have one steering wheel and one accelerator pedal.
So what's the mechanical failure point in that semi-truck scenario?
It's the bond spread. If the ECB sees inflation rising across the Eurozone, they have to raise interest rates. That increases borrowing costs for every member nation. However, global bond investors do not view German debt and Italian debt as carrying the exact same level of risk.
Sure, because Italy has a much higher debt-to-GDP ratio. So investors demand a higher yield, like a risk premium, to hold Italian bonds compared to German bonds.
Right. And that gap in yield between the two is called the spread. Now, if the ECB hikes rates too aggressively, the market starts to panic about Italy's ability to afford these new, much higher interest payments.
So they sell.
They start dumping Italian bonds. And when they sell, that drives the yield on those bonds even higher, which widens the spread violently. If that spread blows out to unsustainable levels, Italy literally gets locked out of the global debt markets.
Which leads to a massive sovereign debt crisis that could just shatter the Eurozone entirely.
Exactly.
But the sources outline a very specific mechanism the ECB created to prevent this from happening, right? The Transition Protection Instrument, the TPI. How does that actually function in practice without undermining their whole inflation fight?
So the TPI basically functions as an active differential gear for that truck metaphor you used. It allows the ECB to selectively intervene in the bond markets.
Selective intervention.
Yeah, so they can raise the baseline interest rate for the entire Eurozone to fight inflation. But simultaneously, they use this TPI tool to go in and purchase the bonds of highly indebted countries like Italy.
Wait, so they step in as the buyer of last resort for Italian debt.
Exactly. And by doing that, they artificially suppress the Italian yield, keeping that spread from blowing out. So they are literally tightening the main monetary valve with one hand while pumping targeted liquidity through a side pipe with the other.
That sounds incredibly fragile. I mean, they're engineering these really complex secondary tools just to survive the structural flaws of their own currency union.
It is fragile. It's an ongoing tightrope walk.
Okay, let's look at the ultimate outlier in global monetary policy, the Bank of Japan, or the BOJ. Because if the ECB is fighting fragmentation and the Fed is fighting domestic inflation, the BOJ has spent decades fighting the exact opposite problem.
Right. Japan has been trapped in this intense deflationary spiral. Stagnant growth, aging demographics, falling prices. So to combat this, the BOJ adopted what is probably the most unorthodox monetary policy in modern history, which is yield curve control, or YCC.
Okay, I am honestly stuck on the mechanics of YCC.
Yeah.
Because traditionally, a central bank only sets the overnight lending rate, right? The absolute shortest end of the curve. And then the open market dictates long-term rates, like the 10-year bond, based on their expectations for future growth and inflation.
That's the traditional model, yes.
So how does a central bank completely override the open free market on a 10-year horizon?
They override the market through infinite quantitative easing.
Infinite.
Infinite. The BOJ publicly commits to capping the yield on the 10-year Japanese government bond at, say, 0%. So if the free market tries to push that yield up to 0.5% or 1%, that BOJ just steps in and buys every single bond being sold on the open market. They buy them until the price goes back up and the yield falls back down to exactly 0. They essentially print an unlimited amount of yen to defend that peg. What's fascinating here is how that impacts the rest of the globe.
Yeah, the global ramifications of that seem massive. Because if I am a Japanese pension fund manager, I have obligations. I have to generate a 3% or 4% return to pay my pensioners. But if my own central bank is artificially pinning the yield of my domestic safe bonds at 0%, I mean, I'm forced to take my capital and leave the country, right?
Which is exactly what happened. And it fueled the largest carry trade in the world.
Okay, explain that carry trade.
So Japanese investors took trillions of dollars of their domestic savings, converted it into foreign currency, and bought U.S. treasuries, European corporate debt, Australian bonds. And by doing this, they supplied massive, massive amounts of capital to the rest of the world.
So because Japanese money was indiscriminately buying global debt just to escape the 0% yields at home, they effectively subsidized the borrowing costs for the entire planet.
Exactly. They suppressed long-term interest rates globally.
Okay, let's take that to its logical conclusion. What happens to the global plumbing when these central bank paths diverge? Like if the Fed is rapidly hiking rates to 5% to fight inflation, but the BOJ stubbornly refuses to abandon yield curve control and keeps their rates pinned at 0, that gap between those two economies becomes a massive chasm.
It does. The interest rate differential just explodes, and the mechanical consequence of that is a currency collapse.
For the yen.
Right. Capital aggressively flees Japan, chasing those juicy 5% yields in the United States. And to execute that trade, investors have to dump the Japanese yen and buy U.S. dollars, so the yen just plummets in value.
And for an island nation like Japan that imports nearly all of its energy and a huge portion of its food, a collapsed currency means the cost of importing oil and wheat just skyrockets.
Exactly. So they finally generate the domestic inflation they've wanted for decades, but it's imported cost-push inflation that just destroys domestic purchasing power. It's a nightmare scenario.
So if central banks control the water pressure flowing through the economy, we really need to look at the pipes themselves to understand why they burst. The sources explicitly state we need to abandon the traditional model of the credit cycle.
Yes, completely.
The classic view that we all learned. Expansion, euphoria, contraction, panic. It's presented as this neat, static season. Why is that framework fundamentally broken for diagnosing systemic risk?
The traditional model fails because it relies heavily on static volume. It assumes that crises trigger simply because the aggregate amount of debt in the system has grown, too large, leading to this speculative euphoria that inevitably collapses under its own weight.
So it's just looking at the total size of the balloon.
Exactly. But that is entirely backward-looking, and it lacks any real diagnostic precision. It doesn't tell an analyst when the break will happen or which specific institutions will fail. The modern, highly precise framework that the sources point to is the path-dependent asset-liability model.
Okay, define path dependency in this specific context.
Path dependency means that the sequence of events and the actual timing of those events matters far more than the absolute magnitude of the debt.
The timing matters more than the amount.
Right. A crisis does not occur just because a firm borrowed $1 billion. A crisis occurs because there is a structural mismatch between the duration of the firm's assets and the duration of its liabilities. And then the macroeconomic environment suddenly changes right at the exact moment they need to refinance.
I really want to walk through the mechanics of that rollover risk. Let's build a scenario for you listening. Let's say a commercial real estate firm wants to develop a massive multifamily apartment complex.
Okay, classic example.
So the construction and leasing process is going to take 5 years before the property actually generates steady rental income. That is a 5-year highly illiquid asset. But how do they actually fund it?
Well, under the traditional model, during an expansionary phase, liquidity is abundant and central bank rates are sitting near zero. So the firm doesn't secure a standard 5-year fixed-rate loan to match their 5-year asset
Why not?
because it's more expensive. Instead, they fund the project using 1-year commercial paper, which is a highly liquid short-term liability. They do this because the interest rate on the 1-year paper is practically zero. It completely maximizes their profit margin.
It's like building an airplane for a 5-hour flight, but you only install a fuel tank that holds 1 hour of fuel. And you're relying entirely on these mid-air refueling tankers just showing up every 60 minutes to keep you in the sky.
That is a brilliant way to look at it. And as long as the weather is clear and the tankers are flying, the flight is incredibly efficient. They just roll over that 1-year debt every 12 months. No problem.
But the path-dependent model looks at that exact same balance sheet and identifies a massive structural vulnerability.
Right.
Because it's a ticking time bomb. It's not the size of the bomb that kills the market, it's the timer.
Exactly. Because what happens when the path changes? Let's say inflation spikes in year 3 of the project, and the central bank aggressively hikes short-term interest rates to cool down the economy.
The weather changes, and suddenly that mid-air refueling tanker charges 5 times as much for fuel, or worse, it just doesn't show up at all.
Right. The firm goes to the capital markets to roll over their 1-year commercial paper, but the environment has completely shifted. Lenders are now demanding a 6% interest rate instead of 1%. And because lenders are nervous about the broader economy slowing down, they demand a higher risk premium for lending to a half-finished real estate project with zero cash flow.
So the firm mathematically cannot afford the new interest payments on that short-term debt.
They hit a wall, the duration mismatch is completely exposed.
And that's when the plumbing ruptures. The firm is forced into liquidation. They have to hold a fire sale, right? Just dumping this half-finished asset onto the market at a massive discount just to satisfy their short-term creditors.
Yes. And when thousands of firms hit this exact same rollover choke point simultaneously, asset prices crash across the entire sector.
So the traditional model would look at that and say, oh, real estate debt was too high. But the path-dependent model says, no, the duration mismatch blew up when the cost of short-term capital exceeded the carrying capacity of the long-term asset.
You've got it. Because if that exact same real estate firm had just taken out a 5-year fixed-rate loan at the very beginning of the project, locking in their cost of capital to perfectly match the duration of their asset, the central bank's rate hikes wouldn't have impacted them at all.
They would have sailed straight through the tightening cycle.
Exactly. The timer on the debt is the actual detonator.
Okay, so if the timer of the refinancing is the detonator, how do financial institutions read the clock? Because the sources point entirely to the yield curve as this ultimate diagnostic tool for anticipating when these mismatches are going to become systemic. So let's deconstruct the yield curve.
Sure. So the yield curve mathematically simply plots the interest rates of sovereign debt like U.S. Treasuries across various maturity dates, from a 1-month bill all the way out to a 30-year bond. In a normal, healthy economic environment, the curve slopes upward. Investors demand a higher rate of return to lock their capital away for 10 years compared to just 2 years, simply to compensate for the unpredictable risks of time and inflation.
Right, I need to get paid more if you're holding my money for a decade. But the shape of that curve is not static. It violently contorts based on central bank policy and the open market's collective intelligence regarding future growth. So I want to break down the specific regimes. Explain the mechanics of a bear flattening.
Okay, a flattening curve means the spread between short-term rates and long-term rates is compressing, getting smaller. A bear flattening occurs when short-term yields are rising aggressively faster than long-term yields.
And this is the mechanical footprint of a central bank tightening cycle, right?
Exactly. The Fed is hiking the overnight rate to combat inflation, which violently pushes up the yield on, say, the 2-year Treasury note.
But wait, why wouldn't the 10-year yield rise just as fast? I mean, if the Fed is hiking rates, shouldn't all borrowing costs across the board go up uniformly?
This is where the market's predictive intelligence overrides the central bank. The bond market looks at these aggressive rate hikes on the short end and calculates that this tightening will inevitably choke off corporate investment and consumer spending.
Leading to an economic slowdown or a full recession.
Right. And because they expect future growth and future inflation to collapse, investors panic and rush to buy safe long-term bonds. This massive sudden demand for the 10-year bond pushes its price up, which inversely suppresses its yield.
Oh, wow. So the market is mathematically front-running the central bank's policy error.
They absolutely are. And if we connect this to the bigger picture, when that dynamic reaches its extreme, the curve actually inverts. The yield on the 2-year note rises higher than the yield on the 10-year bond.
And an inverted yield curve is universally considered the ultimate warning klaxon for recession. Why is that? What's the mechanism?
Because an inversion signals that the fundamental business model of the banking sector is mathematically broken.
Okay, explain that.
Banks operate on a principle called maturity transformation. They take in short-term liabilities, which are customer deposits and short-term interbank loans, and they lend that capital out as long-term assets, like 30-year mortgages or corporate loans.
So their profit margin is just the spread between their short-term cost of funding and the long-term yield of the loan they give out.
Right. This is called the net interest margin. But if the yield curve inverts, the bank's short-term funding costs actually exceed the return they can get on a newly issued long-term loan.
Their net interest margin goes completely negative.
Yes, they literally lose money on every single new loan they underwrite.
So what is the logical action for the bank? I mean, they stop lending.
They stop lending, they tighten their credit standards dramatically, they refuse to roll over that 1-year commercial paper for the real estate firm we discussed earlier. The flow of credit in the economy just freezes.
Which brings up this wild concept of reflexivity. The yield curve isn't just predicting a recession. The mechanical reality of an inverted curve actively starves the economy of credit, thereby causing the very recession it was predicting.
Exactly. It's a self-fulfilling prophecy.
Okay, so let's look at the inverse regime. What is the mechanical driver behind a bull steepening?
A bull steepening occurs when the yield curve rapidly regains its normal upward slope. But it does so because the short end of the curve is collapsing. The 2-year yield just drops like a stone.
Why?
This happens when the central bank realizes the economy is breaking. Total panic sets in, and they aggressively slash the overnight rate back to zero to inject liquidity and try to save the system.
I see the nuance there. Because a steep curve usually implies healthy growth, right? But a bull steepening is actually a distress signal. It means the central bank is applying the defibrillator. The short rates are plunging because the system is literally in cardiac arrest.
Exactly. It reflects severe economic deterioration. The long end might also drop a bit due to a flight to safety, but the short end just plummets much faster as the Fed capitulates.
So the sequence is vital here. The curve bear flattens as the Fed hikes, it inverts as the banks choke on negative margins, and then it bull steepens as the Fed frantically cuts rates as the recession officially begins.
That is the exact life cycle of a policy-induced bust.
Okay, so we've established how the central bank manipulates the pressure and how the yield curve dictates the cost of the credit flowing through the pipes. But to truly diagnose the health of the macroeconomy, we have to look at the people actually doing the borrowing.
We have to evaluate the ultimate end user of that credit.
Right. Let's move from the macro sky down to the kitchen table. Let's transition to the consumer macro playbook, because the consumer is the engine block of the global economy. In the United States alone, consumer spending accounts for roughly 60 to 70% of gross domestic product.
Right. And if your models accurately predict central bank policy and bank lending standards, but they fail to account for the mechanical realities of the consumer's actual balance sheet, your macro diagnosis will be completely wrong.
So how does the playbook recommend we analyze them?
The analytical framework requires treating the average household exactly like a mini corporation. Every household operates with a definitive income statement and a balance sheet.
Okay, let's dissect the income statement first. A family generates revenue through wages and salaries, and against that revenue, they have operating expenses. But traditional analysis often just looks at, aggregate wage growth versus aggregate inflation. The playbook demands a strict segregation of expenses, right? Into fixed costs versus variable costs.
Yes, that segregation is everything. Fixed costs are the absolute non-negotiables. The mortgage or rent payment, auto loans, minimum credit card payments, basic utilities, insurance.
Stuff you have to pay or you lose your life infrastructure.
Yeah, exactly. Whereas variable costs are totally discretionary. Dining out, vacations, entertainment, buying luxury goods. The analytical key to predicting consumer behavior lies entirely in the fixed costs, specifically a metric called the debt service ratio, or DSR.
Walk me through the mechanics of the DSR.
The debt service ratio is simply the percentage of a household's disposable income that is mathematically consumed by required debt payments.
Okay, so give us an example.
Let's say a household brings in $6,000 a month after taxes, and their combined mortgage, car loan, and minimum credit card payments equal $1,500. Their DSR is 25%. This metric dictates their overall economic elasticity.
Let's tie this back to the yield curve and path dependency we talked about earlier.
Yeah.
If the Fed hikes rates, the short end of the curve spikes. How does that directly rupture the consumer's income statement?
It immediately attacks any variable rate liabilities the consumer holds. Now, a 30-year fixed mortgage obviously won't change, but the interest rates on credit cards, auto loans, and adjustable rate mortgages are pegged directly to the short end of the curve.
Oh, so as the Fed hikes, the monthly payments on those variable debts automatically increase.
Exactly. The household's DSR climbs mechanically, even if they haven't taken on a single dollar of new debt.
The vice grip just tightens. And since they cannot legally default on their fixed costs without losing their home or their car, the only mathematical option they have is to slash their variable expenses.
Right. They cancel the summer vacation, they stop buying consumer electronics, they stop going to restaurants on Friday nights.
And when millions of households simultaneously reach that specific DSR threshold and slash their discretionary spending, corporate revenues collapse, which leads to mass layoffs.
Which means the recession begins at the kitchen table long before it ever hits the stock market.
Wow. But the income statement is only half the picture. We must evaluate the consumer balance sheet, their assets versus their liabilities.
Right, and for the vast majority of the middle class, their balance sheet is almost entirely dominated by a single, highly illiquid asset.
Their primary residence.
And a single massive liability, the mortgage attached to it. The sources detail this specific phenomenon called cross-collateralization that basically turns the standard setup into a systemic explosive.
How does cross-collateralization actually work? Let's use the housing boom of the mid-2000s as an example.
Perfect example. So cross-collateralization occurs when a single underlying asset is used to secure multiple layers of debt. So a family purchases a home with a primary mortgage. Over the next 3 years, the speculative market drives the appraised value of that home up by, say, 40%.
So the household now has significant equity on paper. They feel wealthy.
Right, but that wealth is completely trapped in the drywall. It's not liquid. So the financial sector offers them a tool to extract it, the home equity line of credit, or HELOC.
They take out a secondary loan using the exact same house as collateral to fund a kitchen renovation or buy an SUV or pay down credit card debt. They're essentially using the house as a corporate ATM.
Exactly. But the critical vulnerability here is that the bank issuing the HELOC is subordinating their claim to the primary mortgage lender.
Now, here's where it gets really interesting. Let me push back on this for a second. I understand why that is incredibly dangerous for the individual family. If housing prices drop, they are underwater on 2 loans instead of 1. But why does an individual consumer taking out a kitchen renovation loan cause systemic risk? How does that threaten a massive global investment bank?
Because of how those primary mortgages were securitized and sold to the global market. Investment banks bundled thousands of those primary mortgages into mortgage-backed securities MBS and sold them to pension funds and sovereign wealth funds globally.
Marketing them as incredibly safe, AAA-rated assets.
Right. The assumption was that even if a few homeowners defaulted, the underlying collateral, the physical house, could be seized and sold to easily cover the bondholders.
But the introduction of the HELOC fundamentally compromised the homeowner's psychology and their capacity to survive a downturn.
Exactly. When the housing market inevitably cooled and property values dropped, millions of households were instantly plunged into negative equity. They owed more on the combined primary mortgage and the HELOC than the house was actually worth.
So they were trapped.
And when the recession hit and unemployment spiked, these families didn't just default on the secondary loan, they strategically defaulted on everything. The sheer volume of simultaneous defaults overwhelmed the primary mortgage market.
The banks foreclosed, but when they tried to sell the collateral, the market was flooded with distressed properties, which drove prices down even further.
And those AAA-rated mortgage-backed securities became toxic waste overnight, freezing the entire global plumbing.
Okay, but treating a family like a corporation has analytical limits, right?
Yeah.
A corporation is a cold, rational entity. If a division is unprofitable, a CEO will ruthlessly liquidate it on a Tuesday morning just to save the bottom line. A family does not operate that way.
No, they don't.
A family will not sell their primary vehicle to pay down a credit card until the repo man literally hooks it to a tow truck. They operate on fear, Pride, denial, and social pressure. Doesn't this emotion make the consumer fundamentally unpredictable? I mean, central banks surely understand that humans are fundamentally irrational actors.
They understand it intimately. In fact, policymakers know that humans suffer from loss aversion and emotional bias. Therefore, modern monetary policy relies heavily on behavioral economics.
Yeah.
Central banks attempt to actively manipulate the consumer's psychological perception of time and value. Which brings us to the core mechanism of central bank influence over the consumer, intertemporal choice.
Intertemporal choice. Okay, demystify that academic jargon for us. What does it actually mean?
It is simply the fundamental everyday decision regarding the timing of consumption. Do I spend my capital to acquire a good today, or do I defer that consumption, save the capital, and spend it tomorrow?
And how do central banks manipulate that choice?
The primary tool they use to nudge that decision is the manipulation of real interest rates.
Okay, we need to define the real rate mechanically for the listener, because the nominal interest rate is just the number the bank advertises on a billboard, right? But the real interest rate is the nominal rate minus the expected rate of inflation.
Correct. The real rate represents the actual change in your purchasing power over time. So if a savings account pays a nominal rate of 5% and inflation is running at 2%, your real interest rate is a positive 3%.
Okay, so in this environment, the central bank is actively rewarding you for delaying consumption. Your purchasing power is mathematically growing. They are nudging you to leave the television on the store shelf and just save your capital.
Yes. But what happens when the central bank forces real rates into negative territory? What if inflation is running at 5%, but the central bank deliberately holds nominal rates down at 1%?
Then your real rate is negative 4%.
Exactly. And this is an aggressive, punitive psychological nudge. Every single day your money sits in the bank, it is mathematically evaporating. You are losing purchasing power.
The central bank is literally penalizing you for saving.
They are attempting to force capital out of bank accounts and into the real economy.
Now add the dynamic of expected inflation to this. How does the consumer's anticipation of future prices warp this intertemporal choice even further?
This raises an important question, because expected inflation is the ultimate accelerant. Imagine a consumer needs to purchase a vehicle. If the macroeconomic environment leads them to believe that, due to supply chain shortages, the price of cars will increase by 20% next year, their behavioral calculus shifts violently.
Right, because if I wait a year, the car costs 20% more. But if I buy it today, I only have to take out an auto loan at a 5% nominal interest rate.
Mathematically, paying the bank 5% interest today is vastly superior to absorbing a 20% price increase tomorrow. The 5% loan feels like free money. High inflation expectations absolutely obliterate the incentive to save. It creates a psychological panic. Buy it now before it becomes unaffordable.
Which is exactly what central banks weaponize during a recession. I mean, think about the classic 0% financing for 72 months. Automotive commercials that just flood the airwaves during an economic downturn.
Right.
When the Fed drops rates to zero, they aren't just making borrowing cheaper, they are actively trying to pull your future consumption into the present to save the current economy. It's like the marshmallow test for adults.
Marshmallow test.
Yeah, the psychological study with kids. If the Fed sets rates to zero, they are basically telling the listener, eat the marshmallow now because tomorrow it's going to be smaller. But aren't they just stealing economic growth from the future to pad the present?
You are describing the fundamental flaw of relying on intertemporal manipulation. Yes, they are pulling demand forward, but there is a finite limit to how much future consumption you can extract.
Right. Once a consumer buys a new car at 0% financing, they are removed from the automotive market for the next 7 years.
Exactly. And to see what happens when pulling future growth into the present goes wrong, or when the transmission mechanism completely fails, we need to look at the historical autopsies from the sources. We need to do a rapid-fire diagnostic of the past 50 years. Let's start with the 1970s.
Okay, the 1970s, the era of stagflation, a macroeconomic nightmare characterized by high inflation and low growth. From an impartial mechanical standpoint, how did the transmission mechanism break down here?
The breakdown in the 1970s was entirely driven by a runaway psychological expectation of inflation. Exogenous shocks, like the OPEC oil embargoes, caused energy prices to skyrocket. Consumers saw the cost of gasoline and groceries rising weekly. Their real wages were falling sharply.
So their intertemporal choice was violently warped. They believed the currency was rapidly losing value.
They expected prices to rise indefinitely. So, to protect their purchasing power, consumers rushed to buy physical goods immediately. They hoarded everything from non-perishable food to basic appliances. You saw people shifting to generic brands, carpooling, changing their entire behavior.
And this panic buying created a massive surge in artificial demand.
Yes. More money was chasing fewer goods, which fundamentally fueled the exact demand pull inflation they were trying to escape. It became a self-fulfilling wage price spiral. The transmission mechanism was literally hijacked by consumer psychology.
And to break that psychological feedback loop, the Federal Reserve, under Paul Volcker, had to hike nominal interest rates to nearly 20%. They had to induce a brutal systemic recession simply to convince the consumer that prices would eventually stop rising.
The consumer's mindset was the ultimate variable.
Okay, now let's fast forward to 2008, the great financial crisis. The mechanics of this failure were entirely different. This was a balance sheet recession.
Right. The 2008 crisis was the catastrophic unraveling of the cross-collateralization we discussed earlier. When the housing bubble collapsed, the global banking system froze. In response, central banks deployed their ultimate weapon. They slashed nominal interest rates to zero and initiated quantitative easing, flooding the commercial banking system with liquidity.
They were offering the cheapest capital in human history. They were waving the biggest behavioral nudge imaginable, practically begging consumers to take out loans and spend money to resuscitate the economy. But the transmission mechanism failed completely. Why didn't the money reach the real economy?
Because the central banks fundamentally misdiagnosed the consumer's balance sheet. You cannot nudge a consumer into taking on more debt when they are already completely insolvent.
Right.
Millions of households had just lost their jobs, and their primary asset, their home, was underwater. They had suffered a massive wealth shock. Their psychological priorities shifted from consumption to pure survival.
They just ignored all the 0% financing commercials.
Completely. When a household is structurally insolvent, their only logical action is desperate deleveraging. The incredibly cheap credit that did manage to filter down to the consumer wasn't used to buy televisions or cars. It was used to refinance existing expensive debt to lower their monthly carrying costs. They systematically paid down their credit cards. They minimized debt rather than maximizing consumption.
So the central bank was essentially pushing on a string. You could flood the commercial banks with reserves, and you could make the cost of borrowing effectively zero. But you cannot force a terrified, broke, over-leveraged consumer to walk into a bank and sign a loan document.
Exactly. The mechanical link between monetary policy and the real economy was entirely severed by the shattered consumer balance sheet. It took nearly a decade of painful deleveraging for those household balance sheets to repair themselves sufficiently to restore normal consumption patterns.
Which brings us to the third autopsy, the one we opened the show with, the pandemic response of 2020.
Yes, the 2020 shock was unprecedented because the economic contraction wasn't caused by a structural banking failure or an inflation spiral. It was a deliberate, synchronized shutdown of the global economy.
And because policymakers had learned from 2008 that monetary policy, simply lowering interest rates, was ineffective at reaching the consumer during a balance sheet crisis, they deployed a radically different mechanism.
They utilized direct fiscal policy. Governments completely bypassed the commercial banking system. They injected capital directly into the household income statement via stimulus checks, forgivable business loans, and massively enhanced unemployment benefits.
The mechanics of this are so fascinating. At the exact moment households were receiving these direct cash injections, the service economy was legally shuttered. You couldn't spend money on vacations, sporting events, or dining out. So the consumer's income statement showed massive artificial revenue while their variable expenses just plummeted.
The mechanical result was a forced savings glut of historic proportions. Household balance sheets, which took a decade to repair after 2008, were suddenly flush with liquid cash literally overnight. The DSR, the debt service ratio, collapsed to multi-decade lows.
And when the lockdowns lifted, the intertemporal choice was unleashed. Consumers had absolutely no incentive to delay consumption because their balance sheets were pristine.
Right. And because the service sector was still struggling to reopen, they channeled that immense pent-up demand entirely into physical, durable goods. Bizarre explosions of buying, like we said, laptops, exercise bikes. This is where the supply chain broke.
Because the physical infrastructure of global trade, the shipping containers, ports, semiconductor foundries, it scaled for predictable linear growth. It cannot physically handle a simultaneous global tsunami of revenge spending for manufactured goods.
The ports gridlocked. Freight costs skyrocketed by 1,000%. This massive supply-demand mismatch ignited the structural inflation we spent the next several years fighting.
Look at the sheer irony of these autopsies.
Yeah.
So what does this all mean? 2008, we tried to fix the plumbing by lowering the pressure, but the pipes were blocked by toxic debt and the water wouldn't flow. In 2020, we decided to bypass the pipes entirely and just dump an ocean of water directly into the living room via direct fiscal stimulus, and we flooded the entire house. Are we just constantly fighting the last war?
It seems that way. It proves definitively that the consumer is the ultimate swing factor. They possess the capacity to totally nullify a central bank's policy through fear and deleveraging, or they can aggressively supercharge it through exuberance and demand pull dynamics.
Let's run a final macro health check to just synthesize everything we've uncovered from the floorboards today. A quick side-by-side diagnostic for you listening.
Okay, so the traditional view assumes central banks act in isolation, just moving a lever that smoothly adjusts domestic economic output. The reality we analyze today is a highly complex, interconnected global plumbing system where the Fed inadvertently crushes emerging markets, the ECB engineers complex secondary tools just to hold their currency union together, and the BOJ's domestic yield suppression subsidizes global debt markets.
And regarding systemic risk, the traditional view argues that danger correlates directly to the aggregate size of the debt bubble.
But the reality is the path-dependent asset liability framework. The size of the debt is completely secondary to the duration mismatch. The crisis triggers when the one-year liability fueling the five-year asset rolls over precisely at the moment the central bank hikes rates, forcing a fire sale of the underlying collateral.
And finally, the consumer. The traditional models view household spending as a predictable output of wage growth. The reality is that the consumer's income statement is dictated by the debt service ratio, their balance sheet is incredibly vulnerable to cross-collateralization, and their behavior is driven by intertemporal psychology and expected inflation.
That is the complete diagnostic.
I want to thank you, the listener, for coming on this exhaustive deep dive with us. We've ripped up the floorboards, we've analyzed the path dependency of credit, and hopefully you can perceive the structural matrix of the global economy with far more clarity now. But I want to leave you with a final, highly provocative thought to explore on your own.
Let's hear it.
Throughout this deep dive, we've seen how the consumer interacts with central bank policy. We saw them ignore the Fed in 2008, and we saw them overwhelm the supply chain with fiscal stimulus in 2020. But analyze the specific structural plumbing of the American consumer right now. What happens to the global macroeconomic framework when we enter a post-interest rate consumer era?
Oh, that is a huge question.
Consider this mechanism. During the massive refinancing wave of 2020 and 2021, a vast majority of U.S. homeowners locked in 30-year fixed-rate mortgages at rock-bottom yields. We're talking 2 or 3%.
Right.
Now, in other countries like the UK or Canada, mortgages float or they reset every few years. But in the U.S., that low rate is locked in for 3 decades.
Right.
If housing is the single largest fixed cost on a household's income statement, and that cost is permanently frozen at 3%, what happens to their debt service ratio when the Federal Reserve hikes the baseline interest rate to 5% or 6%? The homeowner's DSR doesn't budge. Their primary expense is completely shielded from the central bank's tightening cycle. So if the American consumer is effectively immune to the Fed's sledgehammer, the traditional transmission mechanism is totally severed. The central bank is desperately trying to reduce the water pressure to cool down inflation, but the consumer's pipe is sealed shut. If the Fed continues to hike rates to slow the economy, but the consumer just shrugs and keeps spending, where does that immense pressure go? Who ends up breaking instead?
That is the multi-trillion-dollar question.
Does the pressure blow out the regional banking sector?
Yeah.
Does it shatter commercial real estate? If the consumer won't break, the Fed must break something else.
And that is the precise diagnostic nightmare that policymakers are attempting to navigate right now. The structure of the pipes has fundamentally changed.
Keep looking under the floorboards. Until next time.